Stop scrolling. In the next few minutes, I'm going to show you how to legally make thousands of dollars disappear from your next tax bill. The government is literally giving away free money before December 31st. And 99% of people will scroll past this and miss out. But here's the catch. You have until midnight on December 31st, New Year's Eve. After that, this opportunity is gone forever. Unfortunately, no extensions, no second chances, and most people, 99% of them, will do absolutely nothing with this information and regret it during tax season next year. Welcome back to the channel, where I teach the economics of your personal finance to help you achieve financial independence. And in this video, I'll show you 10 IRS-approved tax strategies that could save you between $1,000 and $5,000 or more on your taxes. But you can only benefit from these strategies if you act fast before midnight on New Year's Eve. Whether you're a complete beginner or you are financially savvy, these year-end tax strategies work for everyone. From W-2 employees to business owners, young professionals to retirees. So grab something to take notes, because you're about to learn something that could change your life and make you smile into the new year. But before we dive in, please do me a quick favor. Hit that subscribe button and turn on notifications. I release new videos every week to help you achieve financial freedom. And here's a quick disclaimer. This video provides educational content only. It's not a substitute for professional advice. I'm not a CPA or financial advisor. Always consult qualified professionals for personalized advice specific to your situation. Now let's get started. Let me ask you something. Would you ignore free money? Of course not. Yet that's exactly what's happening right now. The government has these things called tax strategies, completely legal moves that can save you thousands, but they all expire at midnight on December 31st, New Year's Eve. Here's what wealthy people figured out decades ago. Taxes aren't a surprise party. They're a game with a rule book. And guess what? That rule book is available to everyone. The only difference? Wealthy people actually use it. In the next few minutes, I'll walk you through 10 completely legal, IRS-approved tax moves for this year. Some take 10 minutes, some take a phone call, but each one could save you hundreds or thousands of dollars. No time to waste. Let's get started right away. Strategy number 1, the invisible income trick. Now picture this. You made $60,000 this year. The IRS is getting ready to tax every single penny of that $60,000. But what if I told you that you could make $7,000 of that income completely invisible to the IRS? Here's the trick. Every dollar you put into a traditional 401k or IRA before December 31st becomes invisible for tax purposes. You made $60,000, but you contributed $7,000 to your retirement account? The IRS only sees $53,000, and that $7,000? Poof, gone, vanished. If you're in the 22% tax bracket, that's $1,540 saved immediately. Not in 5 years, not maybe, but right now. That's real money staying in your pocket instead of going to Uncle Sam. For this year, you can contribute up to $23,500 to a 401k if you're under 50. If you're 50 or older, you can contribute up to $31,000. For IRAs, it's $7,000 if you're under 50, or $8,000 if you're over 50. Here's something new. If you're between ages 60 and 63, there's a special super catch-up that lets you contribute even more to your 401k. You don't have to max it out. Even an extra $1,000 makes a difference. And here's the best part. If your employer matches contributions, that's literally free money. Not taking that match is like ordering food at a restaurant, paying for it, and then walking out before they bring it to you. It makes no sense. Now your action step. Log into your payroll system right now. Increase your contribution for your last paychecks of this year. Even a small bump matters. The deadline is December 31st. Strategy number 2. Turn your losses into money. Let's be honest. Not every investment you made this year was a winner. Maybe you bought some stock that went up $5,000. Great. But you also bought something else? Maybe crypto that lost $3,000? Not so great. But here's where it gets interesting. This is called tax loss harvesting. If you sell those losing investments before December 31st this year, you can use those losses to cancel out your gains. Let's say you made $5,000 on one stock and lost $3,000 on another. Simply sell the loser before December 31st. And now you only pay taxes on $2,000 instead of $5,000. And here's the bonus. If your losses are bigger than your gains, you can use up to $3,000 of those losses to reduce your regular income too. You're literally turning bad investments into tax deductions. That's making lemonade from financial lemons. Now there's one rule you need to know. The wash sale rule. You can't sell a stock for a loss and then buy it back within 30 days. The IRS isn't stupid. But here's the workaround. You can sell one S&P 500 fund and immediately buy a different S&P 500 fund from another company. Same exposure. Tax benefit unlocked. Now your action step. Open your brokerage account right now. Find your losing positions. Decide which ones to sell before December 31st. Just make sure you actually want to sell them. Don't let the tax tail wag the investment dog. Strategy number 3. The charity power move. If you donate to charity regularly, you're probably doing it wrong. Not the giving part. That's great. But the tax strategy part? Here's why. The standard deduction for this year is $15,000 for single people and $30,000 for married couples. Unless your donations plus other deductions exceed that, you get zero extra tax benefit. Your $3,000 in donations? Financially invisible. So here's the genius move. Instead of donating $4,000 every year for 3 years, donate all $12,000 in 1 year. Year 1, you itemize and get the full deduction. Years 2 and 3, you take the standard deduction. Same total giving, way more tax savings. But what if the charity needs money every year? Enter the donor advised fund. You put all $12,000 in the fund this year and get the tax deduction now. Then the fund sends money to your charities over the next 3 years. You get the tax benefit up front. Charities get consistent funding. Everybody wins. Here's a pro tip. If you have stocks that have gone up in value, donate the actual shares instead of selling them and donating cash. You avoid capital gains tax and still get the charitable deduction. It's a double tax benefit. Now your action step. If you were planning to donate anyway, consider doing multiple years' worth before December 31st. Research donor-advised funds at Fidelity, Schwab, or Vanguard. Execute donations before midnight on New Year's Eve. Strategy number 4. The triple tax-free unicorn. The health savings account is the most underrated account in personal finance. It's like a retirement account, a medical piggy bank, and a tax shelter had a baby. And it's the only account with 3 separate tax benefits. Benefit number 1. Money going in is tax deductible, just like a 401k. Benefit number 2. Money growing inside is tax-free, just like a Roth IRA. Benefit number 3. Money coming out for medical expenses is tax-free. Unlike any other account, 3 tax benefits in one account. It's the unicorn of tax-advantaged accounts. For this year, you can contribute $4,300 if you're single or $8,550 for a family. If you're 55 or older, add another $1,000. Here's a secret wealthy people know. Pay for medical expenses out of pocket now. Save all the receipts. Let your HSA grow for 20 years. Then reimburse yourself tax-free decades later. There's no time limit on reimbursements. You're basically using your HSA as a second retirement account with better tax treatment. The catch? You need a high deductible health plan to qualify, but if you have one, not maxing out your HSA is leaving money on the table. Now your action step. Check if your health plan is HSA eligible. If it is, contribute the maximum before December 31st. Strategy number 5. Don't give the IRS 25% of your money. This one's for my older viewers. If you're 73 or older this year, or 75 if you were born in 1960 or later, the IRS requires you to take money out of your traditional retirement accounts every year. It's called a required minimum distribution, or RMD for short. This is the government saying, you've deferred taxes long enough, time to pay up. And if you forget to take your RMD by December 31st this year, the penalty is brutal. You'll have to forfeit 25% of the amount you were supposed to withdraw. Let's say you were supposed to take out $10,000 by December 31st and you forget, then you owe a $2,500 penalty. That's $2,500 just for being forgetful, and you still have to pay the taxes on top of that. Here's the smart move. If you don't need the RMD money, you can donate it directly to charity using a qualified charitable distribution. The distribution satisfies your RMD requirement, but it never hits your taxable income. You help a charity and reduce your tax bill. You can donate up to $108,000 this way before the year ends. It's a win-win. Now, your action step. If you're 73 or older and haven't taken your RMD yet, do it now. Call your financial institution today. Don't wait until December 30th when everyone is panicking. Strategy number 6. Use it or watch it vanish. If you have a flexible spending account, or FSA, listen up. FSAs are like Cinderella's carriage. At midnight on December 31st, they turn back into a pumpkin. Your money, poof, gone, vanished into thin air. The FSA rule is brutal. Use it or lose it. Some plans have a grace period until March 15th the following year. Some let you roll over $660 into the new year. But many plans, December 31st of the current year is game over. Whatever you didn't spend disappears. So what can you buy? Prescription sunglasses, first aid kits, sunscreen, contact lenses, dental work, new glasses, over-the-counter medications. They became FSA eligible a few years ago. Stock up on everything medical you'll need in the new year. Now your action step. Log into your FSA account right now. Check your balance. Make a shopping list. Order online or book that dentist appointment before it's too late. Strategy number 7. Get 30% back from Uncle Sam, thanks to the Inflation Reduction Act. Still in effect for this year. There are massive tax credits for making your home energy efficient. And when I say massive, I mean thousands of dollars. Not deductions, credits. That's money directly off your tax bill. You can get 30% back on energy efficient windows, doors, insulation, heat pumps, and HVAC systems, up to $1,200 per year. And there's a separate 30% credit with no annual limit for solar panels, solar water heaters, geothermal heat pumps, and battery storage. Real numbers. Install $30,000 worth of solar panels before December 31st. You get a $9,000 tax credit. That's $9,000 off your next tax bill. Even smaller improvements count. New energy-efficient windows might save you $360 in taxes. The key? The improvement must be installed and operational by December 31st. Scheduled for January doesn't count. So if you've been thinking about these upgrades, now's the time. Now your action step. If you're planning home improvements, check if they qualify for this year credits. Get them installed before December 31st. Save all receipts and manufacturer certification statements. Strategy number 8. Stop giving free loans to the government. Do you usually get a big tax refund every April? Congratulations! You just gave the government an interest-free loan all year. They used your money for free in the tax year, then gave it back the following year like they were doing you a favor. That's not a win. That's you being a very generous banker to Uncle Sam. A $3,000 refund, means you had an extra $250 every month in the tax year that could have been earning 4% interest in a high-yield savings account, paying down credit card debt, or invested in the stock market. Over 30 years, that difference is over $200,000. Not a typo. $200,000. The goal is simple. Get as close to zero owed and zero refund as possible. Your withholding should match your actual tax bill. How to fix it? Use the free IRS tax withholding estimator on irs.gov. It takes 10 minutes. It'll tell you if you're having too much or too little withheld for the current tax year. Then adjust your W-4 with your employer. Now your action step. Visit the IRS withholding estimator right now. If you still have the time and opportunity, adjust your W-4 if needed before your final paycheck for the current tax year. Stop giving interest-free loans to the government. Strategy number 9. Lock in the tax rates for the current tax year. A Roth conversion is when you take money from a traditional IRA, pay taxes on it in the current tax year, and move it to a Roth IRA where it grows tax-free forever. Why would you want to pay taxes now? Because you think your tax rate will be higher in the future. This makes sense if and only if you had a low-income year in the current tax year. You're early in your career in a low tax bracket. You think tax rates are going up in the future, or you want to leave tax-free money to your kids. Now here's the strategy. Convert just enough to stay in your current tax bracket without bumping into the next one. If you're in the 22% bracket, for example, and there's room before hitting 24%, convert that amount. Don't overshoot and pay more taxes than necessary. This is complex. For large conversions, consult a CPA or tax advisor. The consultation cost is usually less than the money they'll save you. Now your action step. Calculate your optimal Roth conversion amount for the current year. Contact your IRA custodian. Execute before December 31st. Strategy number 10. The itemizer's secret. State and local tax deductions are capped at $10,000 per year, but if you're right on the edge of itemizing in the current year, prepaying apart the next tax before December 31st this year could push you over the threshold. And here's how. Let's say you have $13,000 in deductions, just barely under the $15,000 standard deduction for the current year. Prepay $2,000 of your next year's property taxes before December 31st this year. Now, you have $15,000 in deductions and get the benefit. Next year, you take the standard deduction. Here's a warning. You can only prepay taxes that have been officially assessed. Some states don't allow it. And if you're subject to the alternative minimum tax, this could backfire. Ensure to consult a tax professional before doing this. Now your action step. Calculate if this makes sense for you in the current tax year. Consult with a tax professional. Don't randomly prepay taxes without understanding the implications. Alright, let's recap. We just covered 10 ways to reduce your next tax bill before December 31st. 1. Max out retirement contributions, up to $23,500 for 401ks. 2. Harvest investment losses. 3. Bunch charitable donations. 4. Fund your HSA, up to $4,300 or $8,550. 5. Take required minimum distributions if you're 73 or older. 6. Spend your FSA money before it vanishes. 7. Make energy-efficient improvements for 30% credits. 8. Fix your withholding. 9. Consider a Roth conversion. 10. Strategically prepay state and local taxes. And here's the thing, you don't need to do all 10. You probably can't do all 10. Some won't even apply to you. But I guarantee at least 2 or 3 of these could save you serious money on your next taxes. The question is, will you actually do something about it? Now here's my challenge for you. Pick one strategy from this video, just one. Spend 30 minutes this week implementing it. Not thinking about it or overthinking it. Not planning to do it someday, but actually doing it. Because here's the truth. The difference between people who pay less in taxes isn't intelligence or luck. It's action. The clock is ticking. You've got until December 31st at 11:59 p.m. After that, these opportunities vanish. No extensions, no do-overs. Your next tax situation gets locked in stone. If this video helped you in any way, please do these 3 things. Hit that like button and subscribe for weekly financial education that sets you up for success. Next, leave a comment below. Which 2 or 3 of these strategies do you plan to implement first? I read every comment and I'll respond to as many as I can. Finally, share this video with someone who might need it. You could be saving them thousands of dollars. And remember this, wealthy folks aren't necessarily smarter than you. They just use the same rulebook that's available to everyone. You've got the information now, you've got the deadline. So what are you going to do about it? Your future self is counting on you. Now stop watching YouTube and go take action immediately. Thank you for watching, and see you next time.